Afternoon, everyone. Thank you for joining us this afternoon for our first ever webinar series in iFast Global Markets. All right, so I'm sure most of you have already seen the outline based on what we posted on our marketing deck. So basically today we'll be going through some basic investment concepts and how you can actually ride on the current trend in the current space of time. So before we begin, I'm just going to introduce myself. My name is Dylan. All right, I'm one of the investment consultants here at iFast Global Markets. So I basically service all the advisors that we have on our platform, and any of the portfolio related questions or queries that you might have, this is where usually I will come and chip in. All right. So I'm just going to start sharing my screen to begin with. Okay, just give me a second. All right. Okay. All right. So we're going to just begin. So before we start, I think just a couple of housekeeping matters. We do have a question and answer chat box in the webinar via Zoom. So if you do have any questions halfway in between, I will actually zoom out and take a look at them if you have any, and then I'll answer them intermittently. If not, we can always wait to the end of our session before we answer any questions that you might have. All right. So I'm just going to begin. All right. We first talk about who we are. So iFast Global Markets, we are actually the investment advisory platform here at iFast Corporation. We were listed, the company was listed in December 2014. So we've been around for about close to over 5 years right now. All right, so we have strong support systems such as myself and a lot of the marketing and operational staff behind us. So we can be considered an all-in-one platform, which allows you to basically manage all your wealth and your solutions over here at the platform. All right, we have 24/7 accessibility as well. So if you need any fund data or certain things, you can always look it out at our platform as well. All right. So we're going to deep dive into our very first topic, which is the investment 101 topic. So based on the outline that we already posted, we'll first talk about why is there even a need to invest, right? I guess most of you must be wondering why at this current point we're talking about such a topic, especially when, there's so much chaos going out there. We don't really know what's going to happen in the next few days or few months for that matter, right? I mean, the virus has taken quite an unprecedented toll on most of our lives, even not just financially, but even physically, right? We are currently in week 2 of the lockdown. We'll see whether that gets extended or hopefully, it gets shortened, all right? So what is investment actually, right? When we talk about investments, it's not just about, okay, what kind of stocks do I buy? What kind of, instruments do I buy? We like to think of investing as more of a overall wealth management solution whereby, just like when you have your own diet plan, right? I'm sure most of you, when we think about having our own diet plans, we don't think about just, oh, I just need to eat more fruits and vegetables. But you also think of things like, okay, maybe I should cut down a little bit on my fried food. Maybe I should, cut down a little bit on this and that. So it's not just about one particular instrument. It's more of thinking about the whole, wealth solution platform holistically. All right. Okay, so this is just an analogy between what investing is and what a diet is, right? So as I mentioned, when you conduct a diet, right, you might want to include not just your food intake, but you also want to balance that with healthy exercise and enough sleep, right? So similarly in the financial planning world, right? And investment is actually, or rather picking the kind of instruments that you will want to have in your overall portfolio, right? It's only actually just one part of the whole pie. You see, as you can see on the right-hand side chart over here, right? The financial planning actually consists of way more than just picking stocks and bonds or whatsoever. They also have to think about, succession planning, buying insurance to protect your assets, right? You also have to plan for your retirement, especially for those who are young, right? You have to, now is actually a very good time to start thinking about retirement and how you're going to survive if, ever such a situation happens again in the future, right? So if you ever go to Google and you type in this word called investment, right? Usually the Google dictionary will give you some brief explanation based on whatever you type in. So if you do type in this, right, in the word investment in Google, you see some of the descriptions over here, like the action or process of investing money for profit. I mean, duh, right? Usually when we talk about investing, the first thing that comes to mind is money. That's why you see the very first definition here has to talk about money. But you also see sometimes when they give you some synonyms, where you see for synonyms for investing, right, they also include things like speculation. Now, I just want to pose a question here. Do you think investment is the same as speculation, right? The answer is actually no, because usually what do we do when we speculate? When we speculate, we basically say things like, oh, it's going to confirm go up, or oh, it's going to confirm go down. But do you actually have any evidence or a well thought out process to substantiate why you think that's the case? Well, clearly, I don't think so, right? That's why it's called speculation, because you're making a decision based on your own guesses that you're picking out from thin air in that sense. But investment is a totally different process, right? Investment is actually a process whereby you actually take calculated risk, a reasoned decision behind why you make a certain buy or why you make a certain sell, right? That's the difference between gambling, right, speculation, versus investment, right? So to break it down, right, investment is actually it's actually a commitment, all right, that requires an outlay of money or capital, where I'll talk a little bit more about this later, to achieve certain financial goal, and you have to organize it via a logical process, right? So to sum it all up, you can actually just look at investment in these 4 points, because investment is a long-term, a long-term process, whereby that's why the very first point over here is called a commitment. Just like in any relationship, right? You don't date a person and you just throw the person out after 1 or 2 days, right? In the same way, when you invest in a certain company or a certain instrument, you're not just going to buy it and sell it after just 1 day and you're done, right? So that's why we always emphasize the long-term nature of investments, right? The second point about requiring an outlay of money or capital, this is actually a very important and interesting point, because if you think about it, right, most of you are actually investing as we speak, like right now, because you see the definition that requires outlay of money slash capital. Now, aside from money, right, capital can also be defined as things like your time. So you're actually sitting down with me on this very fine Friday afternoon, right, from 1 to 3 p.m. to actually talk about investing and how you can actually plan for your wealth. So this is in fact already an investment in itself, right? You're actually taking some time to learn about these things, right? You want to do this to achieve certain financial goals, and you organize it via a logical process. Right? There's always a reasoning behind why you do a certain thing. Okay, so then you add discipline and some planning to that. This is basically what will make you a successful investor. Okay, so these are some points that we usually, advisors or, even individuals can start asking yourself. These are some of the questions that you might literally actually just ask yourself when it comes to doing investing. So first of all, your age, right? People always say, when you're younger, you tend to have a little bit more horizon, because assuming you are a Singaporean, you're born in Singapore, the average life expectancy is about 80. Let's say you're 20 right now versus a 40-year-old man, you have an extra 20 years to play in the investment game or in the wealth planning game for that matter. So because of that, your ability to take risk, right, is also much higher, right? So age is always usually one of the first questions that you want to ask yourself, because that would determine how much risk you can also take in a general purpose, right? So other things to consider would be your budget. How much are you intending to make, or how much are you intending to set aside for that matter, right? That's called budgeting. And also the time frame. How long are you actually intending to play this game? So once again, it goes back to the discipline process, right? The commitment thing we talked about just now. Are you planning to play this game for only 1 year, or are you in it for the long term, 5 years, 10 years down the road? When you start planning for your retirement, I don't think we're only investing for 1 year, right? Okay, so that's for time frame. So that will translate into things like your tolerance for risk, for volatility, and of course things to consider would be also whether you have any liquidity needs in the long term or in the short term. So parents, if you have kids going to university in say 5 or 10 years time, you might consider buying a bond, for example, that pays you a stable coupon every year, so that 5 years down the road when the bond expires, assuming the company doesn't default, you will have sufficient monies to finance your children's education. So these are some examples that investment can really play real roles in your actual lives, and why it's so important, rather than just going to work, clicking a salary, and that's it, you're done. Because I think there's just so much more to doing investments than just making money, because of these kind of real impacts that it can have in your actual lives, right? So this goes back to the point about having a younger age versus a older age. Okay, so as you can, I'm just going to start with the right hand side chart first. Okay, so you see that if a person starts investing when he's younger, right, the green line, when he starts at 25 versus, let's say, he starts later at 35, you notice that if he starts younger, assuming a same rate of return, right, of course, at the end of a certain amount of time, a certain number of years, his wealth would have grown much more substantially than if you had started later. Okay, because this is actually attributable to the power of compounding. If I were to swift your attention to the left-hand side chart right now, because if you start earlier and you're basically, what we mean by compounding means we actually take our returns and we continue to put it back into the investment instrument that we use. So think of it like your bank account, right? You always receive some interest. The question is, do you take the interest out of your bank account and use it to spend on your own, or do you actually take the interest and you pump it back into your bank account? Similarly, the same thing applies to investment here, right? The power of compounding. So when you take that money and you invest it back into your pot to grow even further, you notice that the green line grows much further than the straight the red line. Yeah. Okay, so the red line, basically the 310,000 at the end of, let's say, 30 years, right? It basically shows you're just earning but you do not reinvest any of your returns. But if you reinvest, then you will let it grow at a much more exponential rate. Okay. So to conclude, this is basically what we're doing on a daily basis. This is my job, my bread and butter, and your advisor's bread and butter as well, right? So we basically help people, help people like yourselves, myself. We set goals at the very beginning, right? We ask these kinds of questions: how much are you intending to make? What kind of return target you're looking at? Risk tolerance. And then after we know you already, then we build a plan together. When we build a plan together, we think about what are the asset allocations that we were looking at, what kind of instruments are more suitable for you, and after we implement it and we monitor it on an ongoing basis, right? So this is, once again, a relationship. A relationship is one that really takes a lot of effort, as most married couples would know, right? It's not a one-way street, so there always has to be a two-way communication, where I have to ask you a certain set of questions and you reply me, and then we'll work on this plan together. Okay, so now we come to the point on discipline. I'm just going to move this to the side so that you can see, right? So this is actually the chart performances of the Dow Jones Industrial Average Index, which is one of the major indexes for US markets, containing 30 stocks, which represents most of the powerful companies in US, right? So you notice that, let me just draw you out an example. A one-day chart for the Dow could look like this, right? So if you read the headlines nowadays, right, every day is up and down, up and down. So on those down days, you see that, the Dow hit 2% lower due to whatever virus-related news, right? And then suddenly you think that, this is the end of the world, you sell your holdings, right? But then even as you observe during this period, right, even in the course of just a 1.5 months, you see that things start to recover after a while, right? We've seen, governments not hesitating at all to step in. Couple that with some resilient economic data from China, although they just reported a bad one this today, but that was kind of expected. You add in things like, maybe the virus situations the cases were starting to ease in certain parts of the world. You see New Zealand starting to slowly open up. That's why you see in the course of just 1.5 months, right, things have started to recover a little bit here and there. But this is, once again, still considered a very short-term play, right? You pull it out 6 months back in history, before things started to happen, you could see even a more volatile. But then the point that I want to make is this, right? If you go on longer and longer and longer, you see that on a 5 years, and even since the 1970s, 1980s, right, what is the general trend you observe? The general trend that you observe is that, the Dow or even general stock market performances tend to always trend up. right? We've seen two major recessions, the Great Depression and the Great Financial Crisis back in 08, 09, right? And then of course, right now we are facing this corona virus recession or led recession, right? But, you know, throughout history or throughout the course of modern history, we've seen so many of these kind of blips, but, you know, the general trend has always been trending up, right? Then the question is why? So we'll get into that later, which is a little bit more of the interesting part. Okay, so before we go into that, we just want to highlight some good investment tips for you to take note for normal dealing, right? So of course, as any sane investor would tell you, you know, don't put all your eggs into one basket to avoid over concentration of risks, right? So if you think that one market might do well in this particular year, you pump your entire you know, life savings into it for whatever reason, you know, something happens, and then you tend to lose all of that in just one move like that. Right. We also try not to time the market, because this is another pitfall that most investors do. It's equivalent to playing with fire, and I'll explain to you why you shouldn't time the market later on. Okay. And of course, this is also because you know, stock markets are generally influenced by two human emotions: fear and greed. Right. When people are greedy, you buy, and after that, when people are fearful, you sell. Right. So two human emotions, these are the two that generally guide the stock markets. Okay, so this is the point on over concentration of risks. So if you were to follow me generally, right, you see so many colors. So these different colored boxes represent, let's say, the different countries, right? And then you see that these have been over the course of, let's say, the last 10 years since 2007. So you see 2007, India was the best performing in that particular year, right? And then over concentration of risk would mean that, oh, because you think India did so well in 2007, you pump all your life savings. You look at what happened in 2008, it actually happened to be the worst performer in the following year. And after that, you sell all your holdings because you thought it was bad, and then you see 2009, it went up again, right? So this basically shows you that you can't really time who is going to be first, who is going to be second based on historical trends, which is why you need to diversify. Right, you need to diversify to hit not just India, but also need to hit China, Singapore, US, etc., because, you know, as you can see in historical chart performances, right, no one has been consistently at the bottom, or no one has consistently been at the top, right? Okay, and of course, trying to time the market is like playing with fire. So to give you a quantitative example, if I were to show you here first, right, all these are the recent, if I pull it back all the way to the 1980s, 1970s, right, you'll see that in the course of history, we've had several large, you know, sell downs or crazy periods where we saw these kinds of panicky times that we are also observing today, right? So if you had panicked, you know, and sold at the highest points, right, you would have lost quite a bit of money, right? Because if you see that if you had stayed to your guns and just held on to your investments, right, and you let it stretch all the way to right now, 2019, 2020, right, you would have made way more money than if you had sold at that moment, right? So this is once again going back to the point on stock markets trending up in the very long term, right? And this is why, you know, if you have that understanding, this is why investing should always be a meaningful part of your wealth planning experience as well. Okay. So here at iFast, this is what we believe. We have four main principles that we abide by when we plan for investments or even make recommendations. So first of all is the diversification argument that I already just presented, and we focus on fundamentals, right? Fundamentals basically means the underlying quality of the company, whether they are really making money or are they making money via money laundering, for example, right? And then valuation driven, meaning to say that we don't want to overpay for anything that is too expensive, right? There are some valuation metrics that we look at, but that's a bit too technical for this session. So in future, if there is sufficient interest, we can always hold, you know, intermediate session on that. And the last point, of course, is to invest it for the long term. Okay, so before I move on to the first asset class, which is the stocks and equities, right? Are there any questions? You can post them in the Q&A if you do have. Okay, I have one right here. So Jimmy Lim is asking, what are your thoughts on risk parity ETFs inspired by Ray Dalio's risk parity strategy, and who is suitable to invest in such ETFs? Okay, this might be a little bit more on the technical side for some of our audience members, but for interest sake, I'm just going to answer this question first. Okay, so ETFs are basically an investment instrument that tracks index performance. All right, so if let's say the STI gives you 10%, ETFs, an ETF that tracks the STI would seek to basically copy and paste that 10%. It's not going to give you 9%, it's not going to give you 11%. 10% means 10%. All right, so ETFs are just one instrument that does this. All right, so the question here is relating to risk parity ETFs. So what is risk parity, right? Risk parity meaning to say that in a investment portfolio, it could contain stocks, it could contain bonds, it could contain other instruments, right? But all these instruments tend to behave very differently in different environments, and therefore they actually have different volatility, different risk levels, right? So what risk parity actually does is that, okay, I don't care if you are 50% risky or 10% risky, I weight each stock holding or bond holding such that on a weighted basis, right, everybody has the same amount of volatility contributing to my portfolio, right? So there are pros and cons to this. So the bad part about this is that, or rather the good part about this is that for those higher, more risky investments, right, the weightage on the portfolio will actually be lower. And then for those lower risk instruments, the weightage on the portfolio would actually be higher, right? So it's more of like a balancing game such that on a net basis, right, each instrument actually contributes equally in terms of risk contribution to the portfolio. So that's the good part about it. You kind of like ease in everybody's volatility, right? But the bad part is that, you know, because all these ETFs base their weighting methodologies on all these quantitative factors, right? So what happens if all these historical annualized volatility figures were actually only contextual in those contexts, right? Then it wouldn't be accurate to say that, oh, just because this particular stock performed very volatile in the last 3 years, then I'm going to underweight it. And then for all you know, in the next 3 years, it is very low volatility, right? Then that could be a downside because you are basing a lot of you know, on the assumptions on historical volatility, historical numbers in that sense. So because of that, you know, that is what I would say is one of the downsides, okay, of risk parity ETFs. So if you want to consider who is suitable to invest in such ETFs, this technically I would look at more institutional investors who have a larger pot to do this, or if you actually have a specific tactical allocation play for such ETFs in these kind of portfolios. All right, so I hope that answers your question on risk parity ETFs. Now I have a second question. So from another perspective, timing the market is applicable to enter at a better price due to greed and fear. One person can just buy at a market price when market is expensive. However, with technical analysis and news, one person are able to make better decisions when timing to enter and exit. So why do you think it is bad to time? Okay, so on a general basis, yes, you know, different investors can play the market differently. So if I were to do a pure TA, pure technical analysis a strategy, right, then I don't even care what time I'm going to go in, because all I look at is, you know, the kind of signals that the stocks are giving me, and then I'll play the stock markets in that way, right? It's basically I basically become a day trader, right, to make my decisions. So in that sense, the timing does matter. But when it comes to long term, when it comes to maybe 3 to 5 years or even 10 years, do you really think I wouldn't really think the timing of when I go in or when I go out is really that important, because, you know, if we go back to the chart that I showed previously on why stock markets trend up in the long run, right? If I had worried so much about the timing back in the 1980s and I draw it out all the way to today, right, then it wouldn't make sense, because it did actually manage to trend up. Right? So if I just leave my money inside and I don't do nothing, I forget about it, 20 years later, you know, by that same trend, it should be able to have been delivering me a much more substantial return in that sense. Right? So once again, we're not saying that it's bad to time, it's just that we don't recommend it for longer term investors. If timing the market has suited you in the past, maybe that is, you know, a particular skill that you might have managed to garner over the course of history. Maybe you can use that to your advantage. But if that's the case, you know, if that's the case, if that works for you, then by all means go ahead. Okay. And maybe one more before I continue. All right. So do you foresee the US dollar will get devalued as world's reserve currency? Okay, so from our house's perspective, we actually don't see the US dollar getting devalued at the current moment because as you have seen, the US dollar is also considered, US treasuries, for example, are also considered one of the world's safe haven assets in these kinds of environments. So, even in the course of the last 1.5 months, you saw people dumping emerging market currencies just to buy up US dollars even in these kind of times, right? And then you also see that the Federal Reserve is starting to amp up their quantitative easing measures again. So when they start printing money, the US dollars will start appreciating. Okay, so we don't adopt the view that it will get valued as the world's reserve currency at this moment. Okay, so those are the questions that I have right now. I'm just going to continue sharing my screen. Okay, so let us continue from where we left off just now on stocks. Okay, so stocks, as most of you know, in most asset classes, right, we have quite a number of things, right? So we have things like your stocks, your bonds, your commodities like your gold, and some alternative assets like your real estate, right? I mean, we Asians, we Singaporeans, we always like our properties and our houses, right? So believe it or not, it's actually also part of your wealth management process. Okay, so these are just some asset classes that you might want to be familiar with. All right, but what is equity? Equity is basically another term for stocks, right? They can basically be used interchangeably. So whenever we mention the term equity, it basically means the company stocks. So basic financial accounting 101 will tell you that equity is basically all the assets minus all the liabilities, and the remaining amount that you get is the shareholders' equity, right? So in terms of that, that's how you define a stock, right? Equities are basically what is available for stockholders to buy into a company. But the more pressing question is why we keep saying things like, oh, a global portfolio of the largest companies in the world will always rise in the long term. All right. The key word here, as we underlined it, right, is always, right? So why don't we take a poll right now, right? If you think that this statement is true, you can keep it in your note. If you think that this statement is false, you can also keep it in your note, and then we can, discuss it later. But my position today is to explain to you why this is the case, and this is why we believe, at least for our lifetime, all right, we haven't seen any meteorites strike Earth yet. So, but this is the case, and why we believe that why stock markets will rise in the long term, and I'll bring you through my arguments slowly. Okay. So before we understand that, we need to understand what causes a company's share price to rise in the first place. It can be summarized into one word: earnings, right? What are earnings? Earnings is basically, as a businessman, you bring in your sales, you minus your costs. That's basically what you make, right? I mean, even a caveman can tell you that. So it's basically your company's profits, right? When you take away your costs, when you make your revenues. Okay, so why do stock markets rise? Because earnings rise. But because the economy is always also growing, and because of the three Ps, which I will talk on bit by bit later on. Okay, so what is the economy? A lot of people always say, oh, the economy is doing well or the economy is doing bad. But, do you really understand what the term the economy is, right? How would I put this? Basic A-level economics will tell you that the economy, or GDP for that matter, right, is defined by your consumption plus investment plus government spending plus exports and minus imports, right? So that exactly is the real definition, right? Who would have known that your A-level syllabus would have been so useful today? So the economy can be summarized into one word called spending, right? So who spends money? Consumers like you and I. Okay, businesses spend money as well. Governments, they spend money, and then of course your foreigners spend money when they come into your country to buy things, or they order things from their own countries and have things delivered to them, right? So if you look at all these things, right, they're actually making up the CIGXM, the consumption, investment, government spending, and then your net exports, right? So all these are the instruments, I would say, who spend money, and that what contributes to the economy as a whole. Okay, so take a look at all these companies. These are just some companies that we've picked up to give you an example of the kind of companies that we deal with on a daily basis right now. So if you take a look at them, which are the companies do you know? Or to actually simplify it, which of them do you not know? Right? Chances are the first thing that you did this morning when you woke up was to look at your phone, right? To check whether the market went up or went down, or to check how many cases there were last night, right? So if you take your eyes to the bottom left-hand side, you'll see the Apple logo there, right? So that's representative of one of the companies that you already spend money on, right? And then what else do we see here? And after you went to take a shower, you have a Dove over here, P&G, right? A Unilever who distributes all these kinds of soaps and shampoos when you took a shower, right? And then what else? Now we have to stay home and order Mac deliveries, right? So you see McDonald's is also listed, Starbucks is also listed, right? So all these companies, you know, you actually spend money on them on almost a daily basis without sometimes even knowing. And when you spend money on these companies, these companies actually benefit, right? So, but why do we care so much about this level of spending, right? Because of earnings and income. With more wealth, with more money going on in the world, there will be more spending, and therefore the economy will be boosted in that sense. Of course, we have taxes to deal with, but that's something that we can't avoid. Okay, so but why is the level of spending in the world rising all the time? You notice that if I were to simplify it for you, it will be the 3 Ps. Okay, the 3 Ps, which I'll go into one by one. The first one is the population, second one is productivity, and the last one is personal drive. All right, so these 3 Ps are what we say power the economy and therefore drive the stock markets up in the long run. Okay, so let's dive into the first P, population growth. All right, so every day, I don't know where my founding co-founder found this stat, but you see every day there's a net increase of 200,000 souls on this planet, if you like, right? So if you to draw back based on World Bank stats, right, in 1997, close to when I was just born, we were only about 6 billion people on this planet. And you fast forward to today, 2020s, 2027s, we're even projecting about 8 billion people on this planet, right? So every 10 years, we're adding close to about 700, 600 million people. And, projecting this throughout the next 10 years, we'll see about 8 billion people on this planet. Okay, so this is another stat by the US Census Bureau. This one is the same world population trajectory that they are predicting. And then this is the more interesting chart. So if you were to go back into, the previous millennium, right? You'll see that, the world population was kind of stagnant in that sense, right? It was like flat all the way until, let's say, somewhere in the 1800s, the 1850s and above. Then suddenly you see, a very sharp increase in number of people. But why was this the case, right? So it's not that, people didn't reproduce or didn't, have babies back then, right? In fact, they probably did it more because, there was no iPhone, there was no laptops, there was no entertainment to keep them going back then. That's why, they probably had more time on their hands. But why is it the case that, this was flat, right? And why was it only in the 1800s? Because the 1800s, you saw things like the steam engine being invented, right? The Industrial Revolution was actually in the 1800s, if I'm not wrong, right? And that actually led to the steam engines, and a lot of productivity was actually being able to be facilitated at that moment, right? Vaccines were invented, antibiotics were invented at that time as well. So even in this crisis, you're reminded that, back in the 1800s, right, you were seeing cutting edge medicines, starting to advance, healthcare starting to advance. Today we treat a normal cough as like, oh, I'm just having a cough, right? But for all back in the 1100 years, right, cough could have been their version of the coronavirus at that time. So who knows? Maybe 20 years down the road, the coronavirus will be just another speck of a blip or bacteria that's hanging in the air, and we say that a vaccine has been invented, and we are all very much protected by it, right? So over the next few years, we project an advancement in healthcare, and we're very confident that will happen, and therefore this will power world population growth going ahead. Okay, so the second P, which is productivity. Oh, before I go on, so why is this so important about rising population growth? Because with more people on the planet, what do people need to do? They need to eat, they need to get entertained, they need to travel, they need to work and all that, right? So with more people on the planet, more souls on the planet, all these will also contribute to the earnings and the spendings on all these companies that will benefit. Okay, so that's the summarizing point. And then we move on to the second P, which is productivity. Now, let's define productivity first, right? So productivity is basically the ability to do more with less, right? I'm sure most of you have experienced that in the last 2 weeks, right? When we were actually forced to work from home, we didn't have access to our offices and our, live locations in Raffles Place or thereof. So we were actually forced to think of ways to use our own processes, refine our processes to get the same amount of work done, right? That's exactly what productivity is, being able to do more with less. So one measure that we like to look at when it comes to productivity is called the GDP per capita. So GDP per capita is basically saying how much money is being made, or how much production is being made by one person in one country, right? So if you pull out the stats, right, the world GDP per capita has been steadily increasing over the years, right? It was, I think, about 10,000 USD in I think 2015, 2016 when we pulled out this data. All right, so that's basically one a measure of productivity, right? And technological advancement, we believe, will be the one factor that will power productivity. So you see that in the late 90s, in the early 2000s, right, the game changer was what? The internet, right? You saw all these big internet companies, the birth of the internet for that matter, coming into play, right? Then in the late 2000s, around 2010, you start seeing things like the smartphones. You start seeing things like iPads starting to come into play, which was what another revolution that happened, right? And then in 2018, 2019, and right now we see things, the new game changers are things like AI, AR, biotech, clean energy, and in fact, maybe even the e-commerce space, right? So you see things like Amazon and Grab. These are the kinds of companies that are revolutionizing our current space today. So the question is, in the next 10 years, in the next decade, right, what would be the new game changer? We don't know for sure, but we will know that it will be an instrument that will, ultimately benefit our technological advancement, which will power our productivity going forward as well, right? And this is also one of the key factors that leads to that, which is tertiary education. You see that in most of the emerging countries, even China, right, a lot of their the families are actually putting their children through tertiary education, right? So with higher education, we also believe that more people will be able to be more skilled to handle such advanced technologies. Okay, and now, so with that, we come to the last P, which is personal drive. So personal drive is basically a simple term or a simple euphemism to say that an intrinsic motivation to want to do better, right? So because everyone wants growth, you don't want to stay stagnant at where you are in the current space, right? I mean, we're all working adults, right? We always have these things called targets that we have to meet, right? Our KPIs. So your boss wouldn't tell you, oh, this year you did X amount, next year you don't have to do so much, right? It's always X plus X plus X, and after X times 10, and then X to the power of X, right? Your targets will keep increasing because everyone wants growth. You always want to do better, and there's an intrinsic human nature to always want to, live a better life, have a better quality life, if you like, right? So because of this, everyone wants growth, which will lead to greater consumption demand, right? We always like to say that, oh, when we work hard, when we are able to afford not just a HDB, we can upgrade to, let's say, a private condominium, or after that it goes on to a Sentosa Cove, and then it just goes on and on. So this is basically what leads to greater consumption demand in the longer run, that we believe will power the economy as well. Okay, and of course, this is also a very fleeting assumption, but I'm also very faithful that this is the case, and that is that we will solve all problems that we will encounter. So, drawing the most recent example aside from the virus would be the GFC, right? The Great Financial Crisis back in 2008 and 9. So back then, a lot of us were losing faith in the monetary system, on the way our lawmakers were operating, letting the rich bankers get away with everything, but, and then there were talks about it being the end of the world. But, the central bank still stepped in at the end of the day. The government still stepped in at the end of the day to save everyone. So because, no one wants a very ugly ending, right? If let's say nobody did anything to save the banks back then, for all we would have seen riots and things going on the street, right? So that's actually a very fair probability of that happening. But because, we are all sane individuals, we will want to solve all the problems we encounter. Maybe even now, the virus situation, we are seeing some advancements and developments in, the potential vaccines that are coming up. We haven't seen a real cure for that yet, but we remain faithful that in the longer run, there will be a big breakthrough for this case. Okay, so capitalism is the economic system of personal drive, which means to say that instead of communism, where the government dictates everything, you decide how much you want to do, right? The harder you work, the more productive you are, the better you will do. Okay, so the 3Ps power the stock markets. This is just another index, global stock index, to show you how world markets have developed over the long term. So you see that we've endured two big blips in the last 20, 30 years, right? The first one was the internet.com bust, and another one was the great financial crisis caused by the banks in 2008, 2009. And now we are I haven't extended this chart yet, but then now we are seeing yet another blip caused by the virus, right? So the question you need to ask yourself on a constant basis is this: are you going to see a downward trend or an upward trend in the next 5 years, 10 years, 15 years, right? Because unless you are going to die tomorrow, which I certainly hope is not the case, right? Then your wealth planning basis should be based on, what's going to happen in the next 5 years, 10 years, and so on, right? It shouldn't be as narrowly confined to, oh, what's going to happen in just the next 1 year? Because I would say, based on this chart, right, that would be too short a time frame for you to make a meaningful investment decision, for that matter. All right, so I just like to summarize it using this supermarket theory, right? Imagine you are this big blue dot here and you are operating a supermarket. So something like Sheng Siong or FairPrice or whatever, right? And all these green dots are the people living around your neighborhood. So if you're the only supermarket in town, right, and all these people need to buy their groceries, right, and and everyone will hoard to you to buy things at this current point, especially, right? So if you're the only one, you have what? You have monopoly power, right? And then the first P happens: population growth, right? With more population or with more people around, there'll be more people coming to your supermarket, more people spending on your things, and therefore you'll make more money, right? Okay, so with population growth, then suddenly everybody wants to get a piece of the action because you are very happening. News gets around that this XYZ supermarket is doing very well in this particular neighborhood. So everyone wants to get a piece of this action, and then you start to see, competitors coming around you. You start to see maybe a marketplace. You start to see wet markets. You start to see Giant or Cold Storage or whatever coming beside you to try to steal or compete for your business as well. Right? So at the end of the day, only the strongest companies will survive, and they will be included in the stock indexes for that matter. Right? So this is the statement that I would like to end with. The most innovative and efficient companies grow to become very big, and then they are included into a country stock index. So what is a country stock index? A country stock index is, for example, the Straits Times Index, right? If I were to use Singapore as an example. So the Straits Times Index is basically a commingling or a combination of the performances of all the powerful and big companies in Singapore, right? So you see things like your three banks, your DBS, OCBCs, and UOBs, and of course, all the major REITs are also inside, right? So there are several benefits to being included in the stock index. Firstly, because it basically says that, you are actually big enough to become considered part of the country stock index, right? And because of that, you gain more visibility, you'll gain more, sight in the financial world. But basically, the point is that only the most big, the most powerful companies and the ones that have been able to survive, over the last course of history will be able to be included in the stock index. The rest of them will not be. Okay, so that this is also a summary that everything that I've been talking about. Okay, and that kind of ends my second session. Yeah. So you can see that once again, chart-wise, most of the markets in the world are always trending up along with earnings, as shown in the orange line, right? Be it Asia, US, Japan, or China, right? The same trend occurs whether you are from the east or the west, north or south, okay? Earnings is one of the key figures or key tenets that drive stock markets in the long run. Okay, so that ends my second part. So before I go into the next part, which is the fixed income department, I'm just going to check on the Q&A to see if there are any questions. Okay, so I have one anonymous attendee who says, do you agree to add gold into the portfolio? Why and why not? Okay, so I'm bound and limited by what I can or cannot say for the purposes of this presentation. All right, so to address this first, I would say that, our research team doesn't cover gold and we don't have an intrinsic price for gold to give you an upside. But then contextually wise or conceptually wise, I can give you some answers on this, right? So do you agree to add gold into a portfolio? From my perspective, there is always a position for gold in any portfolio. It doesn't have to be a very big portion of your portfolio, perhaps maybe a tactical 5 to 10%. Why is this the case? Because of a couple of reasons on why gold has been viewed as a safe haven asset in terms of especially in this kind of times of massive volatility. People usually buy up gold, not just in terms of ETFs, but some of them are even buying the real physical gold, right? It's because it's considered a long considered safe haven asset to lower their overall volatilities. Right. But having said that, you also see gold sometimes becoming potentially a risk asset as well, because over the long term, China and India have become very big buyers of gold because of all their jewelry makers, right? And then, you have instruments like ETFs, right? Your ETFs that allow you to, gain traction into the exposure into the price of gold as well. So when we come across a time like this, when we are faced with massive volatility and there's indiscriminate selling, the old saying "cash is king" actually comes very much into play at this moment. So it doesn't matter if you're holding on to stocks, bonds, gold, property, or whatever. In a time like this, when there's massive panic and fear all around, and there's indiscriminate selling, right? People will usually tend to sell a lot of things. Although gold may or may not be sold as much as stocks, but then this is just something that you have to also consider when you want to have an allocation to gold in your portfolio. But having said that, once again, based on historical correlations, gold has demonstrated to be of a lower correlation to your traditional stocks and bonds. So there is always a place for some gold allocation in your portfolio. Okay. Now, the second question is, isn't it also the reason that companies want to get public's money so they decided to get listed in the stock exchange? Oh, okay. So yes, there are some benefits of being included in the stock exchange when you get listed. But what I was referring to is being included into an index. So there is actually a difference between getting listed versus getting included into an index. So when you get listed, when you're publicly listed, yes, so you have to, file all your documents with the exchange, with SGX and this and that. But to be included into the STI, the Straits Times Index, which is a combination of select top companies in Singapore, that would be a different case. So you don't get to decide whether you get included into the index, but the index provider actually decides for you. Okay. So that answers the second question. So the third question by Benedict is that QE ought to lead to a weakening dollar, but it has been strengthened versus the SGD. Is it because of poor Singapore economic performance that has also weakened the SGD relative to USD? When can we expect USD back to below 140? Okay, so in terms of the actual level, we don't particularly make particular special calls on which prices of as on when or when to go in and out, because we don't have a currency play over here as well. But we do observe that, over the course of the 1.5 months, right, we do see that USD strengthening, but also because of SG strengthening, because once again, people may be selling, the Asian economies funds, and maybe because of that, when they sell Asian stocks, the currency actually depreciates. And then that actually strengthens the USD as well. right? So, but aside from that, I think it's also a little bit more demand driven, where they buy up a lot of US dollars themselves, or maybe US dollar denominated securities, or even the treasuries, right? So because of that, that's why the USD also appreciated in this time. Okay, now the fourth question on Gillette. So with Gillette potentially coming up with the COVID-19 vaccine, earnings could be beaten down this quarter. Do you think the market will rise or fall? Okay, so I'm just going to be very particular in the way I answer this question. So I'm just going to break this down first, okay? So with Gillette potentially coming up with the COVID-19 vaccine, first of all, it's not a vaccine. I think it's just a drug or some cure. So a vaccine is something that will immunize you completely from COVID-19 infections, right? Earnings could be beaten down this quarter. So I don't know why you would say that the earnings could be beaten down this quarter if, let's say, they really do develop a vaccine. But if you look at some of the recent earnings releases from some of the pharmaceutical companies in the US, right, Abbott Laboratories actually just posted an earnings beat. Even in the last one quarter, right? So Abbott Laboratories is the company that developed that 5-minute test thing, if I'm not wrong. Yeah, they developed that 5-minute test for the COVID-19 virus. So and I think just last night they released their earnings for this quarter, and they said that they did manage to beat expectations. So because of that, it's still quite hard to say, because a lot of companies, some have been posting losses, like the banks, or some of them have actually been managing to still keep afloat. So it is very difficult to say who is going to be who's going to make the market rise or fall at this point, because many industries differ based on their performances in the last one quarter alone, right? So, but what we can say, what we do say, is that the last one quarter has, although it has been bad, we do see a potential recovery in the second half of the year and beyond, right? So because of that, we do still advise our clients, advise our prospects to stay invested, buy on the dips, because the fundamentals of quality companies are still very much intact. All right, this goes down once again to your time horizon on whether you are intending to play this game for just one quarter alone, or are you going to stay invested for at least a year or above. Okay. And one more question before we continue. So the last question here would be, earnings are likely to be hit for the next few quarters for most companies in this year, FY 2020. So would you still recommend entering positions in equities right now, or heavier weight in safer havens like fixed income, profitable defensive stocks, and say the yen? Because COVID-19 is, after all, unprecedented. So we cannot assume this is a V-shape or L-shape or any recovery at all. Okay, so quite a mouthful there. Once again, I'm just going to break this down in small bits that we can tackle individually. All right, so earnings are likely to be hit for the next few quarters. Yes, for most companies in FY 2020. It's not likely, it's surely. Okay, we've already seen that happen in the last 2 days or 3 days when companies in the US started to post earnings. So would you still recommend entering positions in equities now, or in heavier weight in safer havens? Okay, so based on valuations, right, our team has actually looked at a measure comparing equity valuations versus fixed income valuations, right? Because of the massive sell down that we saw in the last 1.5 months or so, we do see that equity valuations are more attractive compared to fixed income at this point, right? So the measure that we actually looked at was the excess earnings yield. The excess earnings yield is defined as the earnings yield of a company minus the, let's say, the bond yields of the 10-year treasury, for example, right? So when we looked at that measure, we saw that, hey, it's trading above more than 2 standard deviations from the last 5 years average. So we do see that equities are actually more, much more attractively valued at this point. So that having said that, like I mentioned in my previous answer, you still have always a place if you want to have an allocation to purported safe havens like gold or the Japanese yen, or even if you want defensive stocks. But the underlying should always be to diversify, because you're not investing for just this quarter. So for all even if the defensive stocks, even if Gillette Sciences posts a massive rally in the last 1 or 2 days, it may or may not continue for the next 1.5 years, for example. Right, so the key is always to stay diversified. right? Because you can never tell who is really going to top who and who is going to bottom who at that point. So staying diversified across most regions is always, and most sectors is always the key to go. And the last point is that we cannot assume this is a V shape or L shape or any recovery at all. So I would agree with the first statement that this may not be, in fact, we are not even assuming anything. We are not assuming a V shape or an L shape because nobody knows, right? There was a slight blip when we saw some forms of recovery in the last weeks or so, when after government stepped in to throw in money. But nevertheless, we didn't call that. We didn't say that the worst is finally over, right? We're not being assumptuous, or we're not being presumptuous of anything, but we are very confident that in the next 1 or 2 years, or even next 5 years, right? We are confident that there will be a recovery, because we don't see this virus situation dragging on, or at least hopefully not for the next 5 years, right? Because I think humans are smarter than that to let that happen as well. Okay, and the last one is what is your take on the current rally? Do you think it's a bullish trap? So there have been mixed answers on this, mixed views on this, on whether we think it's a bullish trap. Because if you look at past rallies, right, we do past what do you call that? Recessions or crisis periods, right? There have been instances where after a massive sell down, then after that suddenly you see some recoveries, and then people were starting to say, oh, this is the end already. We are poised for, a longer stretch recovery. But, once again, we are not trying to time the market here, because until we see, that specific to the current situation, until we see a clear flattening or a clear, signal that, the worst is behind us, right? We will not make a definitive call that, this is the end of the bear market, and now is the time to catch the bottom and ride the wave for the next 5 or 10 years, for example. We're not making that call. So what we do know is that we have seen a massive sell-down of at least minimum 20% in most markets to date, right? From the year-to-date highs. So with that point, it depends on whether you want to catch the exact bottom, or do you want to catch around the bottom, right? So we all know that it's already at a very low point. The question is, are you now enough, that such that you need to catch the exact bottom, or are you comfortable with a current level such that 1 year later, when the price recovers, you're okay, or you're acceptable with that level of return, right? If you are a stickler for catching the exact bottoms, then it's going to be a much more difficult task, because no one can really tell when the exact bottom is, right? Even Warren Buffett wouldn't be able to do that task. So what we do recommend to our clients is that, we stay invested, and even if we do buy in, we buy into the markets in small tranches. So at least we catch points around the bottom, but we don't know when the real exact bottom is. Okay, so I hope that answers your question on the current rally. Okay, so now we're going to move on to the third part of my presentation, which is bonds. So this one might be a bit more technical, but I already removed a lot of the technical terms. So for bonds, it's a totally different animal compared to your stocks, right? So we always hear people talking about stocks and bonds, right? So stocks are where you get your growth and where your company's growth from, but bonds are more of a fixed income play. That's why it's called fixed income, right? The kind of a sustainable income that you will draw from a company. So what is a bond first, right? So instead of buying into a company's stock, right, you're actually buying into a company's debt. Okay, so when you buy into a bond, the company is basically saying, okay, I borrow money from you, let's say 250,000, right? For the next 5 years, every year I'll pay you, let's say, for example, 5% coupon, right? 5% interest. And then from there, every year, all the way until the last 5 years, assuming all the coupons are paid, at the end of the 5 years, I will return you your money, right? So in that sense, you can think of bonds as an income play. And if the coupon rate was fixed, which most of the time they are, right? You can call it fixed income. That's why there's this whole segment in financial markets called fixed income, right? So some of the terms that you need to look at is, your face value, the coupon that you will get, and then the maturity date. So are you buying into this bond that will last for 5 years, last for 3 years, last for 10 years, things like that. So all these are or the other terms that you need to look out for. Okay, so then of course there's also been a lot of these terms thrown around, like your price, your coupon, and your yield. So just to be clear, the coupon is not the same as the yield, right? The yield is more of a representation of the total return that you will get by investing in this bond, but the coupon is the level of the payout that the company states they will pay you on a on an annual basis. All right, and of course the price of the bond is a measure of where it is being traded in its life. So one thing very special about bonds, right, is that when they are first issued, right, think of it as an IPO, think of it as a bond IPO, but when they are first issued, they start at the price of 100, right? This is called par. And then throughout its life, it can trade, maybe it goes up to 105, maybe it goes down to 98, right? Maybe it goes down to 90. We have even seen cases of 60, okay? But we do see that assuming everything is okay with the company at the end of the life of the bond, right? After the end of the bond matures already, right? There is an end game situation, right? That it will mature back again at 100. Okay, so once again, the price of the bond is very important because it gives you the level of where it's trading at during its life. It starts at 100, it can go up and down, up and down, up and down, but it will mature back at the par price of 100 again. So for bonds, there's always a end game situation, if you'd like. Okay, so this is already what I talked about just now, right? The face value, coupon, and maturity date, some things to note. And then one more, some of the other technical areas that you might also want to pay attention to is the credit ratings. So this was more of a hot potato back in the 08-09 financial crisis, you know, when people were relying a lot on these kind of credit ratings to see how high the quality of a bond was. So credit ratings are basically, you know, stamps of approval by credit rating agencies like Moody's and Standard & Poor's S&P, right? That basically say how solvent you are, or how likely you are as a company to pay back your debt holders' monies, right? So if you are rated AAA by, let's say, S&P, Standard & Poor's, you are deemed to be of the cream of the crop. You know, you are very low probability of defaulting, very low chance of defaulting. You know, you're considered a very safe, in the eyes of these credit rating agencies, you're considered very safe, good issuers, good companies in that sense, with stable balance sheets and so on and so forth, right? And then as you go down from AAA, right, you go down AA to single A, the kind of quality that these rating agencies ascribe to you will kind of decrease, right? So you see from AAA, it goes down to triple B, and then all the way to D when you're in this category called junk bonds already. So if you are in this category called junk bonds, right, you are more likely in their eyes, higher probability of defaulting on your bond. All right. So if you are kind of investor that cannot take this kind of risk, right, chances are you will tend to invest in the first maybe 4 tranches, or first 4 categories in that sense, the triple A's all the way to triple B's, right? So these 4 are what we know as investment grade. So investment grade bonds are basically bonds that, you know, in the eyes of Standard & Poor's and Moody's and all these rating agencies, they have a higher confidence level that you'll be able to pay back the monies of the bondholders. But if you invest in the junk bonds, or what we call high yield bonds, right? High yield because when you're in this kind of junk status, right, you will have to compensate your investors with a higher level of interest. So think of it as just like when you take a loan from a bank, right? The bank will always ask you for, okay, show me your last 10 months or last 12 months of income statements, for that matter, right? Because they want to have a certainty that you are able to pay back the loan monies, right? So, but then if you show them, you know, a very volatile income statement, let's say you're, you know, a self-employed person who is just starting out, right? And you want to take a $1 million loan, right? Then you show them income statements that you maybe one month you can earn 10,000, you know, the second month you can be a negative 20,000, and then the next month you can, you know, so if it fluctuates that much, right, the bank will likely say that, okay, we're going to charge you a higher interest rate because, you know, we don't trust that, you know, going forward you will be able to pay back, so we need to charge you a higher interest rate. So in the same way for, you know, this bond universe, right, the high yield bonds, although they might be of you know, lower credit rating by all these rating agencies, they will have to compensate you with a higher level of interest in that sense. So because of that, once again, it goes down to whether you are able to stomach that kind of risk to take on junk bonds in your portfolio. Okay, and then similarly, investment grade bonds will typically give you a lower what do you call that, coupons, lower interest. Okay, and another way to look at it is also the seniority of the bond. So we have all the way from senior secured all the way to stockholders. So this is the order in which bondholders will get paid in the event the company gets liquidated. Okay, so if the company goes into a bankruptcy situation, all the senior secured people, all the senior secured bonds will get paid off first. Then only after all these monies have been paid, then okay, we move on to the senior unsecured, then we move on to the subordinated, and then so on and so forth. Okay, if let's say by the senior secured, all the money has been paid already and there's no money left to be paid, then all these below it will not be paid a single cent. Okay, so this is also something to take note of when you go into seniority. And then in the bond universe, there's so much things you can play. Okay, just like stocks, you can go into technology stocks or real estate stocks or American stocks or whatever, right? In the bond universe, you can also do it the same way. You can choose your bonds based on the kind of companies by the issuer, be it a government, are these government bonds you're planning to buy or corporate company bonds, right? So we just talk about credit ratings as well, investment grade versus high yield, or duration, right? Duration meaning how long you want to play the bonds. Okay, we classify them by whether they also have callability or are they perpetual securities. All right, so these are more technical topics which I will not talk about today. And then a seniority we just talked on by coupon as well, whether the coupon is fixed or can it be floating or variable. All right, and then bank capitals. This one is more for if you want to buy into a bank's bonds, you have to see where the money is actually sitting. Is it in the AT1 capital or in other tiers? Okay, so this is just another relationship between price, coupon, and yield. So we already talked about the price. For yields and price, right? Just note that they move in opposite ways. Okay, so when the yields of bonds go up, the price will come down, and then vice versa. Okay, so that's just something to take note of. So there are several reasons why you should also consider bonds in your portfolio, and likely so, because firstly, like I mentioned, it gives you a very predictable cash flow. So if let's say you buy, ignoring this example, right? Let's say you buy a Temasek bond. Temasek, you know that it's a very stable or even a very safe, considered a safe government-linked entity, right? That will have a very low probability of being default. Right. So if it pays you, let's say 5% a year, and that 5% translates to some form of income that is sufficient for you, then bonds are actually a very good additional income play for you to generate some extra liquidity aside from your own salaries, right? So that's one of the benefits. So aside from cash flow, you can actually time it in that sense that you can actually work backwards. So once again, I like to use the example of planning for your children's education, right? So if you need, let's say, 250,000 plus dollars of US dollars, in 5 years' time, then you might want to look for a US dollar bond that pays you a certain amount of money every year, such that at the end of the 5 years, all the monies have been generated, and then you can actually use that monies and liquidity to finance your children's education or whatever need that you might have, right? Okay, so that's also another benefit of investing into bonds, right? It gives you that very sustainable income play. And of course, this is also one of our favorite plays, which is to lower overall volatility. So there was one question just now about, purported safe havens, right? So we typically see that equities and bonds move in opposite directions, okay? But sometimes during stress periods, like right now, they all move together at the same way, right? Because people are just running to cash. But on a normal time, on a normal basis, typically, if you observe the red line here, right, is representative of a company's stocks. It can go up and down, and it's very volatile over the course of in this 5 years. But then you see that the performance of the bond has been relatively stable. So if you're one investor that can't really stomach a lot of risk, then you can consider, investing in bonds to lower your overall portfolio volatility as well. Okay. Some risk to take note of, liquidity risk, meaning to say whether there is enough buyers and sellers in the market. Credit risk is perhaps the most important also when investing in bonds, because you're worried about whether the company will default or not, right? Interest rate risk, meaning to say when interest rates are rising, bonds typically don't do as well because, back in Finance 101, with a higher interest rate, when you discount back your cash flows, right, it will be lower, and therefore it will also affect the valuation of your bond. Okay, inflation risk is also the same thing, and currency risk, whether you're playing a USD, SGD, what kind of denomination are you buying into the bond? Because if you buy into, let's say, an AUD bond, and then the AUD takes a hit, which it has rightly done so in the last year or so, then maybe some of your coupons might be affected when you convert it back into SGD, for example, right? So these are some risks to take note of. Okay, primary and secondary market, this is something technical. So the primary market on where bonds come from, right? So for the primary market is basically when the issuers first issue the bonds, right? So if, let's say, I'm Singtel, today I issue a bond to you, that's basically the primary market. It's coming from me, right? The actual company. So after I issue the bonds, it goes into the hands of the actual investors already, right? That becomes the secondary market. So for example, you can buy my bond, and after that you sell that bond to another friend, for example, or another investor. So that is in the secondary market already. So primary market is always from the source, and then the secondary market is in trading in the market. Okay, so this is kind of an illustration. So we see that for equity trading, right, the stock exchange happens, is where everything happens, right? All the buyers and sellers just do their transactions on the stock exchange, right? But for bonds, it's a little bit different because it's based on over-the-counter basis. So whenever you place in orders for a bond via us, for example, right, I will have to get my bonds team to go and look out in the market for all the counterparties who are selling the bond at what price, and then we'll choose the best price for you, and then we'll give you the bond. Okay, so this is how buying and selling works for bonds. Okay, so that concludes my third part on fixed income investing. And before I go into the last part on unit trusts, I'll just take a couple of questions. Okay, so the first one is on are credit rating agencies independent? Okay, so very interesting question because by right they are, but by left, we saw in 2008, 2009, right, that they were actually being paid to give credit ratings, AAA credit ratings on even those securities that were not AAA rated, right? So if you were to look into the historical, I don't know, reports or something, right, you'll see that they actually gave AAA ratings onto securities that were probably in the quality of double Bs, for example, right? So it was quite a corrupt system back then because they were just being paid to give their stamps, give their chops on those securities. But by right, I think they've tightened up all the regulations right now, so we can actually place quite a fair bit of confidence on these new credit ratings. I mean, of course, if you do your own due diligence and you see that, hey, why is this poor quality security trading at a AAA rated rating, then maybe there's something that you might want to go and question the company's management or the credit rating agency yourself. Okay. So the next question from Jimmy Lim. All right, last year the big shots Michael Burry sees a bubble in passive investing. Despite the current stock market correction, are we really at risk of passive investing bubble? Okay, so this is actually very interesting because I did address this last year when the article first got released. So I think he compared passive investing instruments such as ETFs, right, to the, the mortgage-backed securities back in 2008 and 2009. So I first disclaimed by saying that these are actually two very different instruments altogether, right? So in that sense, you can't really make an apple-to-apple comparison. But secondly, the risk of passive investing is also a little bit limited because ETFs probably only make up, about 3 to 6% of the entire, I can't remember the actual figure, but I remember it's a low single digit, right? Passive investing ETFs actually will only make up quite a small bit of the entire investment universe. So a lot of it is actually in the active space. So even if there is a bubble, the overall impact on the overall financial market would be quite small as well. We also don't judge that to be happening. The only risk I see is that once you include a lot of companies into a particular index that we were talking about just now, right? So once more and more companies are entering indexes, and if we don't do our due diligence, we just follow where the money flows, that's where the potential bubble could happen, right? So it's also very important to look at the kind of index, the kind of companies that are being included inside, right? So that's why passive is sometimes not always considered fully passive, right? You have to look at what index you are looking to track, what kind of companies are going inside, and whether there is really just blind flows going in. So to quote you an example, right? It doesn't even have to be happen in passive investing. So if you remember in December 2018, when Donald Trump first started his trade war nonsense with China, right? And then we saw a massive sell down in December 2018. Remember that? And then somewhere just after Christmas, we saw a very massive V-shaped recovery, and we enjoyed a very nice 2019. But what people didn't really see was that the very initial V-shaped recovery point, right, was actually not so much of normal equity normal equity inflows. It was actually a lot due to hedge funds trying to cover up their short positions in the month of December. So because of that, a lot of flows went in from the hedge funds, and then that actually just led on to a snowballing effect, and people started to buy more, and then, you know, fundamentals were changed, and then earnings revisions, and after it continued on. So, you know, it doesn't have to be just limited to the passive investing space. It can actually happen anywhere in the financial markets. That's why, you know, once again, it remains to be seen. And it's very important to stay diversified, you know, stay invested for the long term, and not just follow blindly on what's happening in just 1 month or so. Okay, so that's it for now. I will continue my last part of the presentation, which is on unit trusts. All right, so for those of you who are, you know, still probably very fairly new to investing, right? And you know about stocks, you know about bonds, but you don't exactly know which ones to buy. Then, you know, thankfully there's an instrument called unit trusts available, right? So what are unit trusts? Unit trusts are basically, sorry, I'm just going to skip all this. Okay, so unit trusts are basically instruments whereby a company commingles funds from all over the investors, right? All the different investors, right? They pool all your monies together, and we give it to this asset manager. In this case, I'm using BlackRock as an example, right? So we pool all our monies, we give it to BlackRock. BlackRock invests into a set of companies for us, professionally managed by all the experts over there, right? The professional portfolio managers, right? They invest into a group of companies, and then if the companies make money, their fund also makes money, and then therefore the returns and income goes back to us as the investors, right? So I think this chart actually kind of sums it up very neatly. So imagine you and I are here, right, in this investors unit holders place. We only maybe have $1,000 each on our hands, right? But when we combine our monies all together, maybe we manage to combine $1 million all together. Then we just give the money to this BlackRock professional asset manager, and then we say, hey, I want to buy technology stocks. Then BlackRock says, okay, I have this fund called the BlackRock World Technology Fund. Okay, so BlackRock World Technology Fund will actually invest in all these tech stocks, minus Johnson & Johnson. I don't know why it's there. Okay, but you'll see all the famous FANGs or technology stocks over there, right? So with all these technology stocks making money, if they make money, my fund makes money also, and therefore I receive all the returns and the income. All right, so that basically is what a unit trust is, right? It's a very simplified instrument. If you don't know what to buy into exactly, you can rely on the professional expertise of these asset managers out there to give you the kind of exposures. Okay, so some things to note for. The first of all is the NAV, the net asset value. So just like how stocks have a share price, right? The funds, they don't have a share price, but they do have a net asset value. So if the fund's value per unit today is $1, then you let it run for maybe 1 month or 2 months, right? And then the fund appreciates to maybe $1.50. In the same way, just like, you know, when you buy and sell stocks, when you buy and sell fund, you also kind of make the same kind of returns, but the returns are based on the underlying companies that the fund invests in. Okay, but of course, it also is not free, because you you need to pay money to all these professional managers to do the homework for you. So there is some form of a management fee in that. and then the kind of share classes you're investing into. So whether you're investing into a Singapore dollar share class or a US dollar share class or so on and so forth. And then finally, whether that fund actually pays you some form of dividends, right? A lot of the fixed income funds, they also have some form of payouts. So that's something to look at as well. Okay, so what are the benefits? The benefits are that it can be started with a very small amount. Once again, it's because you're not doing this alone. We are doing this together. We are pooling our monies all together and we're giving it to the professional managers to handle it, right? So we're doing it by a team effort. So you don't have to have a lot of investment amount. Minimum starting points are usually about Singapore dollar, about $1,000, USD $1,000, and subsequent amounts would be in the range of $100 to $200. All right. So it gives you exposure to a lot of things. So instead of just buying, let's say, Google, for example, the fund actually buys into Google, Amazon, Facebook, etc., etc. So you're actually getting way more exposure than just one stock alone. All right. And then, of course, it's managed by the experts, the professional managers who have been doing this for the rest of their lives, you know, the better half of their life. So they are very experienced and they know how to look at companies, right? And they're very highly diversified. Okay, so there are many kinds of unit trusts that you can buy into. So there are equity funds, there are fixed income funds. You know, some of them are balanced as well, meaning a mix of both, and alternative investments, which actually is another animal altogether because it actually involves some of the more esoteric strategies like managed futures, for example. Yeah. Okay, so these are some examples. So, when we talk about diversification, right, it's not so much just a single country. So you can buy into, let's say, a US fund, but you can also buy into an Asian fund, Asia ex Japan, right? Asia ex Japan means you cover China, you cover India, you cover, you know, Singapore, and so on and so forth. And of course, you also have funds that invest globally. So global equity funds would be, you know, those that invest in almost every part of the world. And then moving on to the right side, we see that, you know, there's even a sectoral or thematic approach. So if you want to invest in just the technology sector, there are funds to do that for you. If you want to invest in just the, you know, the healthcare sector, there are also some funds available for you to do that. All right, so there's quite a number of a diverse range of funds that you can invest into to diversify your wealth. And, you know, it is only, the sky is the limit, basically, on what you can invest in. Okay, even in the fixed income space, you see that, you know, there's so many ranges of things that you can look into. You can, for example, you can invest into an Asian high yield, short duration local currency fund, for example, you know, and then you can mix and match and see what the fund managers are offering you. All right. And then balanced funds is a combination of both. So you have both equity and fixed income components inside. All right. So this was what I was talking about just now, right? You want a piece of all the action of the FANG stocks, right? Or the technology stocks. So you don't know which ones to buy, or you don't know how to buy them, when to get in and when to get out. There is a particular fund available for you, right? So Franklin Templeton, the asset manager in this case, is managing a $3.2 billion fund, right? Once again, it's pulling all our monies together. They've been doing this since 2000. Right, when the birth of the internet was just at its place, right, and then it has 76 companies under their watch. All right, so true enough, you know, their returns have been doing quite well over the last 5 years or so. Okay, and these are some of the companies in their top 10 holdings as of October 2019. It's probably, sorry, this is quite a little bit outdated, but these are some of the companies back then that they were holding. Okay, and then we Asians, we like our properties, right? But then we may or may not have sufficient liquidity to own this whole land of space. So once again, there is another fund that invests in REITs, right? So we like our REITs, like our Capital Lands and our Frasers and our Maple Trees, right? But then what's particularly interesting about this fund by UOB Asset Management is that it's not just investing in Singapore REITs, but it also invests in, you know, REITs in the Asia Pacific region, like Japan, Australia, New Zealand, right? Performance-wise, it has done pretty well over the last 5 years. Okay, and then you see that, you know, the allocations wise, you see that, you know, Japan, Australia, Singapore, Hong Kong, you're not just getting REITs in one area like Singapore, but you're also touching other areas in Asia alone. Okay, so I think even a personal touch for me is that, you know, you've all seen the movie Crazy Rich Asians, right? So, you know, if you want to think of yourself as one of those moguls who own all these things, you know, this fund, I would say, is one way you can potentially get invested into real estate in properties in the Asian region. Okay, so this is just an ending slide, right? People usually ask, okay, so you gave me all the funds, right? Which one is good? Which one is better? Which one is worse? So typically when we look at historical performances, we tend to look at, okay, who gave me the best return, right? Based on this example, if I show you an example of fund ABC, right, with different annualized returns over the last 3 years and different annualized volatilities as well. So volatility is just another measure for risk, right? So it's a game of high risk, high return, low risk, low return, right? Just like anything in life, right? So when you look at these three funds here, can you tell me which one is better in that sense? So most of the time, people will just look at who gave me the best return, right? So if you look at it, it was Fund B, right? Fund B had 15% over the last 3 years, but you also notice that it came with the highest amount of risk. Okay, so then you say, okay, I want low risk. Then you go into Fund C, right? But in this example, Fund C, I'm using the Sharpe ratio to determine my best bang for the buck, if you would like. So this is a bit of a technical measure, but basically you're taking the portfolio's return, you divide it by the per unit amount of risk after you minus the risk-free rate. Okay, so basically, when you calculate, you see that Fund C is in this case the best because it has the highest Sharpe ratio. Right, if this is too confusing for you, don't worry, you know, because these are just some of the technical terms that we look at when we do our fund comparison. Okay, but if you are very interested to know how to go about doing these investments, right, you can always do it yourself via our DIY platform. Okay, we have an app for that, or you can also sign up with us with advisor assisted accounts. Okay, so for those of you who like to do it yourself, we actually have an app where we have online stocks trading from as low as $8. You can download it on your app store. It's you can just type iGM or iFast Global Markets and then it will be there. Okay, so this is the DIY app. And then for those of you who also already know some iGM advisors, please speak to your advisors. Or if you are interested to getting to know some of our advisors here to, you know, better able to help you manage your portfolios or grow your wealth together with you, you can contact us at this email or dial in at the hotline. Okay, so that is pretty much it. I'm just going to see if there are any questions. There are no questions at this point. Oh, okay, I see it, one here. Just now you shared about the benefits of unit trusts. So how about the cons of unit trusts? Okay, so one typical con I would say is that, you know, when you buy into a unit trust, it's an active management, right? So you're basically saying that the portfolio manager in question has quite a good skill in delivering you the kind of performance that you might expect. But then if let's say you are getting a manager that it's not particularly effective, then you're actually not benefiting at all, right? Because if you're paying him management fees to do his job, but he's still delivering you weak returns, then there's no point investing in this particular unit trust. You might as well just buy an ETF that tracks the market, and if that will do better, right? Other what do you call that? Other cons I would say is that, you know, sometimes when it gets too diversified, then you also, you know, won't really get enough concentrated exposures into certain sectors, for example, right? So if let's say you were to buy into a global fund that invests in 10,000 over securities, right? Then, you know, with just a bit of money, you are spreading your money too wide, right? So yes, diversify, but you also need to look at the way, you know, the unit trust strategizers or how they allocate their monies. So this is where, you know, your financial advisors, our financial advisors will be better able to be equipped to guide you along on which funds you can navigate yourself with. Because, you know, sometimes when we just look at a fact sheet, right, we might not be able to tell how the fund manager actually does his job. So your advisors like us, we will usually get in touch with all these fund managers and we'll question them and we'll roast them alive to see how are they going to get the returns for us in the next 5 years or so. So that's how we can better value add to you when you work with us as well. All right. So I see that's all for now. Yeah, those are the only questions left. So yeah, we have no other questions at this point. So once again, thank you for joining us. If you have any feedback, please do let us know as well. You can always leave a comment in these inquiries at ifastgm.com, or you can dial in and listen to us. All right, if there's any demand for new topics, we can always explore doing them in the next few series as well. All right, so I think I see another one last question over here. Okay, don't have. Okay, thanks. All right, so that's all for now. I wish you good health. Stay safe. Stay at home. All right. God bless you. God bless everyone. Thank you.